We've been writing about this, and we've talked about it before, Tom, you and I, about a change in eras here. We exited definitively the Great Moderation era that went from the mid to late 1990s up until the 2022 inflation spike. And that was an environment where you had mostly disinflation, fairly benign inflation risk, relatively limited inflation volatility, as well as limited economic volatility. That ship has sailed. And I think what we're in now is something that looks a little bit more like what we've been calling the temperamental era, which is the period from the mid 60s to the mid 90s. The big difference between them is the relationship between bond yields and stock prices. So in the temperamental era, you had a very, very consistent relationship where when bond yields went up, stock prices went down. And that's because what was driving yields was more on the inflation side of the spectrum, not the growth side of the spectrum. Great moderation, growth was driving yields. So higher yields, higher stock prices. I think we're reverting back to something that looks a little bit more like the temperamental era.
So I guess that calls into question, maybe even more so, we need to have a strong view on where rates are going. How do you guys feel about that at Schwab?
It's not just the level of rates that I think matters as a feeder into the equity market, but the speed of the move. Okay. Also, the shape of the yield curve. So right now, I think the direction and maybe more recently, the speed accrues to the disadvantage of the equity market, but the shape of the yield curve right now is still relatively positive. I think the net of all of this is that we have to be a little bit more creative when it comes to diversification, because when you have bond yields and stock prices moving in the opposite direction, that means bond prices and stock prices are moving in the same direction. And that's why you're seeing interest in diversification in other areas, whether it's within the fixed income sphere and the move into corporate debt, or even into things like investing in the hold build out of kind of the sports ecosystem. So I think it requires a thinking about diversification that is a little bit more complex than it has been in an environment where 60-40 tends to work in a more simple way.
Earnings. Corporate America has certainly been doing its part, Liz Ann, with some better than good in the second quarter, better than even in the first quarter, which were pretty stellar themselves. How sustainable is this level of earnings growth, do you think?
Probably not long-term sustainable. And that's maybe the reason why you're not seeing analysts extrapolate the 30% plus surprise factor for the second quarter into quarters consistently out. We've got that differential between where earnings are now and depreciation catching up as it relates to the AI spend. I think that has to be taken into consideration. This is the first time ever we've seen a parabolic ascent like this in earnings. July 1st, the consensus was for 24% growth for the second quarter. We're now over 50%. That move up from a growth rate change perspective is unmatched, other than coming out of the two most recent recessions, where the base effects accrue to the benefit of that surge in earnings. That's clearly not the case this time.
Liz Ann Sonders, we're going to continue with her. She's, of course, with Charles Schwab here. Futures deteriorate -36. I'm not to a 16 VIX yet. As Liz Ann suggests, there's a contained feeling to this, even with a backup in yields. 4.19 in the 2-year, rounded up 4.74% on the 10-year. The 30-year, we had a 5.33. Right now comes into a 5.32. Robin Brooks, who's been wonderful on this, publishes like 8 charts on Twitter of all the different governments. He leads with U.S. and France is the most fragile. That's his opinion. I'm not giving my opinion here, but there it is. Some economic data out. Import prices come in below survey. They're up bigly, but not like what was expected. Housing starts a little soggy, to say the least. There's some energy on the screen here as we look at that, with yields coming in a little bit. We continue with Liz Ann Sonders of Charles Schwab. Liz Ann, how far out is your view? When you started out, I remember this, she was 15. She's on Lou Rukeyser. She's just killing it for Mr. Schwab and all that. You could look out 3 years. How far out are you and Kevin modeling right now?
I think you still need to look out over a multi-year period of time. The problem is that that's not what investors are doing right now. Time horizons have gotten so much shorter, and we're finding that there's even some longer term, more disciplined strategic asset allocation oriented investors that are starting to shorten time horizons and sort of move more toward that trading approach. And it's also part of the reason why we've been emphasizing the blurring of the lines between investing and gambling. And I think that that heightened focus on gambling has also served to shorten time horizons. So I think this is an environment where you want to reinforce longer term time horizons, because that's when you reconnect prices to fundamentals. In the short term, it could be narrative changes that have a lifespan of nanoseconds.
Right. Liz Ann's killed that, folks, on Bloomberg Money here a number of weeks ago. We'll recapitulate. 3, 2, 1. We'll recapitulate that in the fourth quarter, if I can speak clearly, wandering into December. I look, Liz Ann, where we are. And the fundamental thing Paul and I are hearing in the studio is people like you and Kevin are talking to people that have extraordinary levels of cash and they don't know what to do with it. What do you say to someone at a barbecue on a Saturday who says, I'm up to my eyeballs in cash?
You know what? Shame on anybody that answers that with a cookie cutter response. Who's the investor? I would stand at the grill until it was cold, asking follow-up questions to then provide any kind of advice as to what allocations should look like, how much cash. I mean, if you're a retired investor and you need to keep all of the principal and live on the income generated from that, a message about what to do with cash is very different than, a 22-year-old that inherited $10 million from grandparents and goes skydiving on the weekend and is gainfully employed and doesn't need the income. So that's the real difference, is understanding. But also, let me mention one other thing as it relates to cash, sort of the general cash on the sidelines. I get questions about this all the time. Isn't this eventually massive fuel for the market, given $7+ trillion in money market mutual funds? The rub there is that it represents somewhere between 10 and 12% of total stock market cap. Compare that to the bottom in 2009, when it was more than 60% of market cap. So we can talk about the level of cash on the sideline, which I don't really like that terminology. But as it relates to how much firepower that represents, you've got to take it in. You've got to take total market cap into consideration. So if you look at a chart of that, it's quite low right now from a firepower perspective.